Want to invest in a business that's practically guaranteed a profit? Like the idea of knowing that customers can't live without the service your investment provides? Does collecting a market smashing yield of 4.7% sound great? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing electricity to millions of customers. Let's get real for a second. Our modern day society would collapse without electricity. Electricity is both ubiquitous and necessary. As you might imagine, companies that provide this necessary electricity tend to make some money. And their stocks tend to pay out big, growing, reliable dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Edison International, which appear to be trading at a significant discount today. Edison International, stock ticker EIX, is a utility holding company for Southern California Edison, an electric utility business that provides electricity to 5 million customers across Southern, Central, and Coastal California. Founded in 1886, Edison International is now a $21 billion by market cap utility giant that employs more than 13,000 people. SCE is their main operating segment. Investing in a utility business such as Edison International is always a pretty straightforward affair with a simple investment thesis. That thesis is that modern day society cannot function without reliable access to power. We basically can't live without electricity. There is a captive consumer base in place because of this. Thus, utility companies that can meet this inherent and unflinching demand for power tend to prosper. And since there is often only one major utility provider in any single geographic area, these businesses further benefit from their monopolistic characteristics. All of this is true for Edison International, giving their business model a powerful 1-2 punch. And this bodes well for their ability to continue increasing their profit and their dividend over the long run. As it stands, they've increased their dividend for 18 consecutive years. Their 10-year dividend growth rate of 7.3% is uncommonly high for a utility business, which is impressive. However, more recent dividend raises have been in the 4% to 5% range. Still, that's plenty of dividend growth when you pair that with the stock's current yield of 4.7%. That yield is more than 3 times higher than what the broader market offers. It's also 100 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 57% based on core earnings per share, the dividend is easily manageable. This is a rather compelling combination of yield and growth, especially in this yield-starved, low-rate environment. Looking at business growth, Edison International grew its revenue from $12.760 billion in fiscal year 2011 to $13.578 billion in fiscal year 2020. That's a compound annual growth rate of 0.69%. It's nothing awe-inspiring, but it's also not out of line for a mature Southern California utility. Earnings per share advanced from $3.22 to $4.52 over this period, which is a compound annual growth rate of 3.84%. Notably, I used the company's core earnings per share. This is a non-GAAP number that factors out discrete items, which give a more meaningful look into earnings power. This growth is neither excellent nor poor for a utility business, in my view. I'd expect annual earnings per share growth to be in the range of around 4% from a utility business such as this, and they're pretty close to that. Looking forward, CFRA does not provide an earnings per share growth forecast for Edison International. However, CFRA does note that it projects, and I quote, revenue growth of 4.3% in 2021 and 3.6% in 2022, unquote. They see the company benefiting from, again, I quote, customer growth and higher rates and higher commercial and industrial volumes, unquote. That kind of top line growth would be a significant bump up from what Edison International has produced over the last decade, and it would lay the foundation for similar, if not better, earnings per share growth. With that kind of earnings per share growth likely to materialize, Edison International should be capable of generating mid-single digit dividend growth for the foreseeable future and beyond. Moving over to the balance sheet, their financial position is slightly weaker than I'd like to see for a mature utility business like this. Their long-term debt to equity ratio is 1.4, while the interest coverage ratio is a bit under 2. Profitability could also be improved somewhat, although fiscal year 2018's GAAP loss unfavorably skews the averages. Over the last 5 years, the firm has averaged annual net margin of 5.48% and an annual return on equity of 5.49%. Again, this is a straightforward investment. There's nothing complicated about the idea of investing in a utility. This company won't knock you dead with growth, but it's typically been a great income producer that has a solid growth kicker attached to it. With economies of scale, a geographic monopoly, and a unique regulatory structure that practically guarantees a profit, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. While a utility doesn't have competition in the traditional sense, there's always a risk that its customers become competitors in the future through more power generation at the point of consumption. And their main market has a heightened amount of regulation that can unnecessarily weigh on the business. There's substantial wildfire risk here. California's AB 1054 legislation provides some prudent financial management as it pertains to smoothing out the burdens of an outsized one-time event, but there are ongoing costs to this protection. California also introduces political risk. A continued push toward greener energy initiatives introduces a near-term growth driver at the cost of long-term uncertainty. Overall, I see this as a solid utility that's made to be more attractive by virtue of its low valuation. The stock's price-to-earnings ratio is only 12.2. Now, that is based on core earnings per share. Still, that's about half of where the broader market is at on a GAAP basis. We can also look at cash flow for more clarity. The price-to-cash flow ratio of 21 is well below the stock's own 5-year average of 28.2. And the yield, as noted earlier, is materially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate due to the elevated yield and a long-term dividend growth rate of 4.5%. This dividend growth rate is on the lower end of what I usually allow for when looking at a utility. However, I think this is a realistic take on the business. Recent dividend raises have been in this range. The long-term earnings per share growth rate is around 4%, and based on CFRA's near-term revenue growth projections, earnings per share should continue to grow in the mid-single digit range. With the payout ratio being moderate, I see this as a reasonable expectation for future dividend growth. The dividend discount model analysis gives me a fair value of $61.54. The reason I use a dividend discount model analysis is because the business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Edison International as a 4-star stock with a fair value estimate of $70. CFRA rates Edison International as a 3-star hold with a 12-month target price of $63. I came out on the low end. Averaging the three numbers out gives us a final valuation of $64.85, which would indicate the stock is possibly 14% undervalued. Here's the bottom line, guys. Edison International is an easy-to-understand utility business offering a necessary service to millions of captive customers. With a market-smashing 4.7% yield, nearly 20 consecutive years of dividend raises, a moderate payout ratio, inflation-beating growth, and the potential that shares are 14% undervalued, this is an under-the-radar stock for dividend growth investors to take a serious look at. And now for a special news announcement. Huntington Ingalls Industries Inc., stock ticker HII, just bagged another massive contract. This one is worth $724 million for planning yard services in support of in-service amphibious ships. This one contract alone is worth about 8% of the company's entire market cap. We highlighted this stock as an undervalued idea to consider back in February when the stock was around $180 a share. It's now over $220 a share and likely headed higher. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.